if you can start by explaining what are those readings which you are looking at, which tells you that the capex cycle in India is actually taking off.
Yeah, so essentially what we are arguing is that, look, when you're thinking about this cycle, the way to think about it is to compare the investment growth trend in this cycle versus 2003 to 7. So in 2003 to 7, we had seen investment to GDP go up from the trough of around 28% to the peak of 39% by F 2008, or call it calendar year 2007. And in this cycle, something similar is happening. We saw investment to GDP troughing at 29% in 2020. And 12 months ended March 24, we're expecting it to have already risen to 34. Going forward, we're expecting further rise to 36% of GDP. So this is an important driver to growth. And the reason why it is important is that if your growth is driven by investments, then there is a lower chance of the country facing macro stability risks like inflation or widening current account deficit. And that's exactly what happened in that cycle as well. Inflation remained very well behaved in the range of 5 to 5.5%, despite GDP growth averaging over 8%. And similarly, current account deficit was well behaved right until middle of 2008, when oil prices had shot up to $148. Even then, current account deficit was below 3%. So we think that this is the important driver in this cycle, just like it was in 2003 to 7, gives it more sustainability in terms of growth outlook.
Very interesting. So you actually are making a case that this time, now that the capex to GDP is actually troughed out, it may cross the previous peak of 34% and may rise all the way to 36%. In fact, Chetan, I was particularly excited to interact with you on this note, because the day I read this note, my guest on the show was Sanjeev Sanyal, and he was making a point too, that there is a reason this time the breadth of growth is actually pretty wide, and he gets a sense that the growth is very durable. What are your thoughts on the way quality of growth is panning out, without causing any macro stress? Do you see durability in this growth and breadth also coming in?
Yeah, that's right. So we've seen that initially it has been driven by within capex, by public capex picking up. And now we are seeing growth broadening out within investment to private investment picking up. And on the consumption side, it has been more evident on the urban consumption side, but we are also seeing early signs of rural consumption improving. So both on the investment and consumption side, we are seeing growth broadening out. But the key anchor to this cycle will be investment growth, and consumption growth will be a bit slower than investment growth, but it's actually necessary to have consumption growth underperforming investment growth, because that's how you will get sustainability to the growth cycle. Because if it is investment driven, then we are creating capacities for growth to ensure that there is not much pickup in inflation. And at the same time, if you have investment driven growth, you would create that income growth acceleration, and from income growth you can see pickup in consumption. So you will have decent consumption growth, just that investment growth will be stronger.
Right, Chetan, this is Vinny joining in the conversation as well. So yes, investment will be growth will be stronger than consumption growth, is what you're saying. You did say that, we are seeing early signs at least of some bit of a rural recovery coming in. When you look at it in the last year, none of these FMCG companies actually have managed to post anything above a 5% volume growth. Very few rare cases have come in terms of that. What's your thought on that? How slow will that recovery be then? Yes, it will be slower than the investment, the consumption recovery trend. But what is that outlook that one should have there?
So, look, I think we should probably not expect a big acceleration in rural consumption growth in terms of FMCG companies' volume growth. For the December quarter, according to AC Nielsen, this has picked up to around 5 to 6%. And I don't think that there should be a significant acceleration from there. And the urban consumption on FMCG will probably still continue to do better in the range of 6 to 7%. That's the kind of numbers we think will be comparable to the overall GDP growth, which we're expecting to be averaging around 6.5% over the next 5 years. So we think that these numbers are fine. I think the concern that the FMCG companies have is the pricing power. Now, to the extent to which earlier they had increased prices because of higher commodity prices and now they have cut prices, that has affected their nominal revenue growth. And which is why you hear the sort of feedback from them that their rural sales are not doing well, but it's more because of the pricing effect. And we think that that pricing effect will correct as we see some normalization going forward that will help their nominal revenue growth.
What are your thoughts on two issues? One is that up till now, as you said, that bulk of the heavy lifting, at least to start with, on the capex side was done by PSUs or the government side, and now there are early signs private sector is catching up. I want to understand how is the capacity utilization across corporate India right now, which gives a sense that, if the capacity utilization is edging higher, then they have to plan for new capex ahead. And the second part is, there is a lot of first two, terms of this government, a lot of work done on infra, etc., capex. And now there is so much talk of next generation reforms. Any thoughts there which it could have, impact it could have on capex cycle?
So look, I think there is enough in the economy in terms of demand for the corporate sector in the private sector to start doing capex, and they have precisely started to do that. But there are two factors which have meant that there has been some slow recovery in private capex. Number one is that for a long period, India had gone through challenges in a way that the corporate sector did not gain confidence. So we've seen severe amount of volatility over the last 10 years. First, there was taper tantrum, and then you had seen demonetization in between. In 2014-15, China had gone through big deflation and slowdown. Then you had GST implementation, then you had trade tensions, then COVID. So corporate sector never really saw a 2-year period of solid gains in domestic demand to have that confidence. And they had been in the last 3-4 years before COVID actually even taking up deleveraging of their balance sheet. So it's going to take some time for them to gain that confidence. And now that we've seen nice 2 years of domestic demand recovery, we are seeing the early signs of private capex picking up. The second factor which has been affecting their confidence is the weakness in exports. Now, exports are still pretty sizable if you take the share of top line for manufacturing sector. And that had been weak for almost all of 2023. But going forward, that should improve too. So with that, strength in domestic demand continuing as well as external demand improving, you should see further pickup of private capex. And of course, there might have been some holding back of investments, especially for the greenfield projects, because of elections. And once elections are done, we think you should see a much stronger pickup in private capex with all these three factors supporting them.